welcome to this week's series of Credent Connect. Today we're going to talk about the January market recap, both from a capital market standpoint and from a broad economic standpoint. And what's been fascinating thus far, or rather last month in January, has been this notion of a broadening of performance. For those of you that watch some of our December 2025 outlooks here for 2026, one of the themes that we honed in on was this fact that the data is pointing to a broadening of returns, meaning that top-heavy structure of the S&P 500, right? The artificial intelligence, AI-heavy technology names are likely to do well, but are not likely to outpace every other stock in the market as they have over the past 5, 6, 7 years. Now, this broadening has been evident both in smaller stocks within the S&P 500. It's been evident in the mid-cap sector of the market, as well as the small-cap sector of the market. And it's significant for multiple reasons, but predominantly being this notion of investors being diversified away from what has been the major momentum trade of the past 5 to 10 years. This is significant because the average stock is notably poised to do better over the next 3 to 4 months relative to the previous 5 years as a function of comparing them to those top artificial intelligence names. The reason for this is multifold, but if you look at just valuations, at least from our perspective, valuations in and of themselves are often the worst timing indicators in the market. In fact, if you just time the market based on valuation multiples only, you would have fared very poorly as an investor. But where valuations have come into fruition so dominantly so far this year is that stretched valuations of segments or sectors of the economy, of the market rather, as those go on over a multi-year period, there tends to be a catalyst, a shift that starts favoring that average stock, that broadening, that depth of the broad capital markets. We believe we're at the precipice of that, and the catalysts have been evident so far in January, actually started as early as late October of 2025. We'll be paying close attention to that here over the next few months because that could be the driver of what diversification could mean here in 2026. From an economic standpoint, it's really important to note that the activity in January is further resonating with that soft landing scenario that we've been talking about over the past 2 years. This idea that the Federal Reserve has had an ability to slow down the economy, slow down consumption with higher interest rates without actually triggering a recession. And the economic data is actually showcasing that to a fairly objective degree. We're seeing a continuation of decent economic data points, but not necessarily a strong, exuberant momentum for that growth. What this may mean is that the economy could very well be entering this neutrality of growth, this sustainability of some of these economic numbers without an exuberance to the upside. That's not a negative and has often been the catalyst for building the base before the next secular growth cycle actually begins. From an investment policy committee standpoint, our goal is to observe this data with such scrutiny that it has allowed us to pivot and reposition to take advantage of that shifting landscape in the market. We continue to believe and are structured as such to take advantage of equity market opportunities above and beyond that of the fixed income market, because as we've always said, and I'd like to remind our investors and clients, the markets rarely react the way the masses expect them to. So if the consensus is that of lower interest rates, or if the consensus is that of an artificial intelligence boom momentum continuing in perpetuity, or if the consensus is that of a dollar further declining, the markets rarely react in the sense that will accomplish all of those predictions. The prudent thing to do is pay attention to them, articulate them, be invested in them, yet the concentration risk that they pose is not something we take on. So staying diversified in this environment is going to be one of the critical components of success for risk management and for essentially playing the the non-conventional card in portfolio management. And as the market conditions change, that financial plan becomes the blueprint of how to mitigate risk, how to play the risk management card. Geopolitical tensions are going to amplify over the next few months. It's a natural cycle of what we've been observing here over the past few weeks, or rather what happened here in January. As that materializes, the need, the desire, the angst to want to exit equity market participation will once again resurface. Similar to, if you recall, the Liberation Day activity of markets back in April of 2025. It's important to stay vigilant in that process. It's important to allow the risk management backdrop that's already embedded across your portfolios to take hold, because opportunities like that are going to arise again, similar like Liberation Day, where we can take advantage, reshift positioning, and allow us to take advantage of that next growth cycle. As always, we're here to help you navigate the markets, uncertainty, questions, or any issues that may arise. So please do not hesitate to reach out, as we are here to guide you through all of such events.